The embattled British pound fell 3.5% against the dollar last Friday after the new UK government announced a radical economic plan in a bid to boost growth. Sterling had dropped as low as $1.084, extending losses it made after the measures were unveiled in the morning in London. The pound has been on a precipitous fall against the greenback this year, hitting levels this month not seen since 1985 when it fell to $1.042. Last Friday's measures were billed by the government as heralding a new era for the UK focused on growth, and included a mix of tax cuts and investment incentives for businesses. Jim O'Neill, former Goldman Sachs Asset Management chairman and a former UK Treasury minister, said the pound's fall shouldn't be misinterpreted as dollar strength. It is a consequence of an extremely risky budget by the new chancellor and a rather timid Bank of England that, so far, has only raised rates reluctantly despite all the clear pressures, he told CNBC Monday. The announcement last Friday featured a volume of tax cuts not seen in Britain since 1972 and an unabashed return to the trickle-down economics promoted by the likes of Ronald Reagan and Margaret Thatcher. The radical policy moves set the UK at odds with most major global economies against a backdrop of sky-high inflation and a cost-of-living crisis. Welcome to Savvy Economists. The market has been in a state of utter disarray as the pound sterling fell to a record level after so many years against the dollar. The fall comes after the newly appointed Minister Liz Truss announced plans for tax cuts. We would dive deeper into the story as the video progresses. Make sure to hit the like button, subscribe and turn on notifications. The pound has hit an all-time low against the dollar after the bonanza of tax cuts and spending measures in Kwasi Kwarteng's mini-budget threatened to undermine confidence in the UK. The pound plunged nearly 5% at one point to $1.0327, its lowest since Britain went decimal in 1971, as belief in the UK's economic management and assets evaporated. Even after stumbling back to $1.05, the currency was down 7% in 2 sessions after the UK Chancellor pledged over the weekend to pursue more tax cuts. Several city economists suggested the slump in the pound could force the Bank of England into an emergency interest rate rise to support the currency. Paul Dales, the chief UK economist at Capital Economics, said the bank could come out with tough talk supported by a large and immediate interest rate hike. That could involve something like a 100 bps or 150 bps hike in interest rates to 3.25%/3.75%, perhaps as soon as this morning, Dales told clients. The shadow chancellor, Rachel Reeves, told Times Radio she was incredibly worried by the market reaction to the mini-budget. As Asia-Pacific markets opened on Monday, Ray Attrell, National Australia Bank's head of currency strategy, said, "It's a case of shoot first and ask questions later, as far as UK assets are concerned." Mark Chandler, the chief market strategist at Bannockburn Global Forex, called the currency's record plunge incredible and said there was bound to be speculation of an emergency Bank of England meeting and rate hike. Chris Weston, the head of research at the brokerage firm Pepperstone, said the pound was the whipping boy of the G10 foreign exchange market, while the UK bond market was getting smoked thanks to Kwarteng's £45 billion debt-financed tax-cutting package. Investors are searching out a response from the Bank of England. They're saying this is not sustainable when you've got deteriorating growth and a twin deficit. The funding requirement needed to pay for the mini-budget means either we need to see far better growth or higher bond yields to incentive capital inflows, Weston said. Kwarteng's mini-budget caused a rout in UK financial markets last Friday. Sterling shed 4 cents to hit a 37-year low of $1.0856, while the jump in the cost of government borrowing was the biggest in a single day in decades. The price of easy fiscal policy was laid bare by the market, said Sanjay Raja, chief UK economist at Deutsche Bank. He said Kwarteng's tax cuts were adding to medium-term inflationary pressures and were raising the risk of a near-term balance of payments crisis. A plan to get the public finances on a sustainable footing will be necessary, but not sufficient for markets to regain confidence in an economy sporting large twin deficits, Raja said. The UK current account deficit, which includes the trade balance and the net income from foreign investment and transfers, had already widened to a record level this year. The jump in the cost of imported energy is adding to this deficit, which is pushing the pound down towards levels that make UK assets attractive to foreign buyers again. Last Friday afternoon, Bloomberg's options pricing model showed there was a 26% chance of the pound and the dollar hitting parity within the next 6 months, up from 14% on Thursday. Courting tried to play down the financial reaction to last Friday's mini-budget, telling BBC One Sunday with Laura Quinsberg that he was focused on boosting longer-term growth, not on short-term market moves. As Chancellor of the Exchequer, I don't comment on market movements. What I am focused on is growing the economy and making sure that Britain is an attractive place to invest, he said. Courting also indicated that Liz Truss plans to radically reshape the UK economy with even more tax cuts and fewer regulations. The Bank of England is expected to raise interest rates higher to combat the inflationary impact of the mini-budget as a weakening pound drives up the costs of imports. The money markets are pricing a doubling of UK interest rates to more than 5% by next summer. After the mini-budget, the UK Debt Management Office plans to raise an additional £72 billion before next April, raising the financing remit in 2022-23 to £234 billion. Sterling is in the firing line as traders are turning their backs on all things British, said David Madden, a market analyst at Equity Capital. There is a creeping feeling the extra government borrowing that is in the pipeline will severely weigh on the UK economy. The FTSE 100 tumbled 2% to a 3-month closing low last Friday. So far this year, the index of blue-chip companies has lost 5%, much less than European or US markets, helped by oil companies and exporters boosted by the weak pound. The Chancellor's high-risk strategy could entail a larger FTSE 100 correction before the year is out, said Charles Archer, a financial writer at online trading platform IG. As monetary policy tightens, mortgage and debt defaults rise, while investment in growth falls. This could render the mini-budget entirely ineffective. Rachel Reeves, the shadow chancellor, started with an attack on Kwasi Kwarteng for the mini-budget announced last Friday. She says the message from financial markets was clear last Friday. Today that message is even more stark. The fall in the value of sterling means prices will go up. It means the cost of borrowing for the government will go up. And the cost of borrowing for families will go up too, she says. All for what? For tax cuts for the wealthiest, she says. Reeves also said she would raise the minimum wage to a level that reflects the real cost of living and reinstate the 45% top-rate tax band to hire more NHS staff. The only previous time the pound was this weak against the dollar was in 1985, and back then, it took intentional government intervention to stem the rampant dollar through the Plaza Accord. That agreement was made at the New York Plaza Hotel. Finance ministers agreed that the US dollar should depreciate after the greenback surged following interest rate hikes to cool US inflation, as we're also seeing today. Liz Truss's spokesman has declined to comment on the market moves, following the hammering given to UK government bonds, and the pound slide to a record low overnight. The spokesman said, "The Chancellor has made clear that he doesn't comment on the movements around the market, and that goes the same for the Prime Minister." The spokesman added there are no plans to make any changes to the measures set out in the so-called mini-budget by Chancellor Kwasi Kwarteng last Friday. That may disappoint investors who were alarmed by the scale of the tax cuts in the mini-budget and the surge in borrowing needed to pay for them. Sushil Wadhwani, a former Bank of England policymaker, argues that the central bank should hold an emergency meeting next week. Wadhwani explains that the bank shouldn't wait until its next scheduled meeting in early November, given the inflationary impact of the weak pound. "If I were still at the BOE, I would be tempted to announce an extra meeting in a week." The argument for waiting a week would be to give them time to properly assess the extra news. The reason for not waiting until November is that they are cognizant of the need to respond on a timely basis to the new developments. Of course, he adds, the BOE taking action is a second-best solution. The first would involve the Chancellor coming up with a credible fiscal plan which is blessed by the OBR. Banks, house builders, and retailers' shares have been worst hit since Kwasi Kwarteng announced his £45 billion fiscal giveaway last Friday, and then hinted that more is coming. That shows the city is anticipating rising bad debts, falling demand for houses, and a deeper consumer spending squeeze. Exporters have done better, thanks to the tumbling pound. Labour leader Keir Starmer has warned that working people would pay the cost of the real turmoil in the financial markets caused by the Conservative government. Ordinary Britons will have to endure higher mortgages and prices as a result of the government's fiscal plans, Starmer said Monday at a Bloomberg business event at Labour's party conference in Liverpool, northwest England. The opposition leader's remarks came after Chancellor of the Exchequer Kwasi Kwarteng last Friday announced the biggest tax giveaway in half a century, sparking a sell-off in the pound and gilts amid market concern about rising government debt and inflation. The net result of last Friday so far is tax down for the richest and prices up for working people, Starmer said. He added that the country was very worried about the message Liz Truss's government was sending. Investors also ditched UK bonds amid a rise in expected government debt. Paul Johnson, director of the Institute for Fiscal Studies, said markets appeared spooked by the scale of the fiscal giveaway and said it represented the highest level of tax cuts in half a century. Yields on 2-year UK government bonds hit their highest level since October 2007, and 10-year yields reached their highest level since 2010. Yields move inversely to prices. The 10-year yield was set for its biggest daily rise since 1998, Reuters reported. At 1:45 p.m. it had risen 26 basis points to 3.759%. UK equity markets also fell, with the FTSE 100 hitting its lowest level since March. It comes after the Bank of England said Thursday that the UK economy was likely already in a recession as it raised interest rates by 50 basis points. Jane Foley, the senior FX strategist at Dutch bank Rabobank, said the market appeared skeptical of the government's 2.5% growth target, though the measures were unashamedly designed to boost demand. The obvious implication is that BOE rates are likely to be higher for longer than they would have been otherwise. While textbooks suggest that higher short-term interest rates should be currency supportive, GBP has been demonstrating since the spring that this is not always the case, she said in a note. With the UK hitting a record debt-to-GDP ratio, the pound is vulnerable to a downward revision if foreign investors are reluctant to fund the deficit, Foley said, and markets are very doubtful of the ability of this government to manage debt. The UK risks a currency crisis that could see the sterling reach parity with the dollar, several analysts warned. We think the UK will find it increasingly difficult to finance this deficit amidst such as deteriorating economic backdrop. Something has to give, and that something will eventually be a much lower exchange rate, said Citi analyst Vasilios Kianakis in a research note quoted by Reuters. The euro was also down against the dollar last Friday afternoon, dropping 1.5% on the day to 97 cents after a release showed the Eurozone's Purchasing Managers Index fell to 48.2 in September. S&P Global said it meant the bloc was likely to enter a recession. The dollar has been boosted this year by equity market volatility and Federal Reserve interest rate rises, but the negative reaction to the pound was still clear, with the euro climbing 2% against sterling to 0.89. Truss and Courting maintained that their sole focus is to boost growth through tax and regulatory reform, with the new finance minister suggesting in a BBC interview on Sunday that more tax cuts could be on the way. However, the plan has drawn criticism for disproportionately benefiting those with the highest incomes. The Independent Institute for Fiscal Studies also accused Courting of gambling on the UK's fiscal sustainability to push through huge tax cuts without even a semblance of an effort to make the public finance numbers add up. As the markets continue to balk at the new Prime Minister's plans, Sky News reported on Monday morning that some Conservative members of Parliament are already submitting letters of no confidence in Truss, only 3 weeks into her tenure, citing fears that she will crash the economy. Will the proclaimed hope of Britain Liz Truss be the one to send it to its deepest peril and despair? Is she just going to be a favorite among the rich with her tax cuts? We would like to know your input on this, and don't forget to like, subscribe, and turn on notifications. Thanks for watching.